The global financial landscape is undergoing a seismic shift, characterized by unprecedented economic policies, rising inflation, geopolitical uncertainties, and fluctuating investor sentiment. While stock markets have enjoyed an extended period of growth over the past decade, largely fueled by low interest rates and expansive monetary policies, the winds are changing. Investors who have focused solely on equities may find themselves exposed as traditional asset classes face new risks. In this evolving scenario, the allure of gold and silver, as reliable hedges against inflation and economic instability, is making a strong comeback. This comprehensive analysis delves into the historical context, current economic dynamics, technical trends, and investment strategies related to gold and silver, aiming to provide a holistic understanding of why these precious metals may be entering a new significant bull market phase. To understand the potential future trajectory of gold and silver, it is crucial to reflect on their historical performance during past economic upheavals. Gold, often referred to as the ultimate safe haven asset, has a history that stretches back thousands of years as a store of value. From ancient civilizations using gold coins to modern central banks holding vast reserves, gold's role as a trusted medium of exchange has remained largely unchallenged. Silver, known as the poor man's gold, has similarly played a significant role, especially as an industrial and monetary metal. Looking back at the 20th century, the Great Depression of 1929 serves as an early example of how gold provided a safe haven during economic collapse. As stock markets plummeted and deflation gripped the global economy, the price of gold held steady, bolstered by the U.S. government's fixed gold standard policy. Decades later, the 1970s saw a similar story during a period of stagflation, high inflation coupled with stagnant economic growth. The removal of the gold standard in 1971 by President Richard Nixon marked a turning point, allowing gold prices to float freely. This led to a spectacular rally, with gold prices increasing nearly tenfold by the end of the decade, driven by runaway inflation, geopolitical tensions, and a loss of confidence in the U.S. dollar. The late 1990s and early 2000s marked another significant period for precious metals. Gold began a prolonged bull market in 1999, rising from a low of around $250 per ounce to a peak of nearly $1,920 in September 2011. This rally was fueled by a combination of factors, including the bursting of the dot-com bubble, the 2008 financial crisis, and aggressive monetary easing by central banks worldwide. Silver, too, experienced a dramatic rise during this period, moving from below $5 per ounce in the early 2000s to almost $50 per ounce in 2011. Investors flocked to precious metals as safe haven assets, amid fears of inflation, currency devaluation, and systemic financial risks. Fast forward to the present day, and we find ourselves at the crossroads of multiple macroeconomic factors that once again favor a bullish outlook for gold and silver. The unprecedented monetary expansion undertaken by central banks in response to the COVID-19 pandemic has fundamentally altered the financial landscape. The Federal Reserve, the European Central Bank, ECB, and other major central banks have injected trillions of dollars into the global economy through quantitative easing, QE programs, aimed at stimulating growth and preventing a deeper recession. While these measures provided short-term relief, they have also sown the seeds of long-term inflationary pressures. Inflation, which had remained subdued for much of the past decade, began to surge in 2021 and 2022, reaching levels not seen in over 40 years. The U.S. Consumer Price Index, CPI, soared, driven by rising energy prices, supply chain disruptions, and increased consumer demand. Central banks initially dismissed this inflation as transitory, but it has proven to be more persistent and broad-based than expected. As a result, the Federal Reserve has been forced to pivot from its accommodative stance to a more hawkish approach, raising interest rates at a rapid pace in an attempt to tame inflation. This shift in monetary policy has created a challenging environment for traditional assets like stocks and bonds. Rising interest rates increase borrowing costs for corporations and consumers alike, putting downward pressure on corporate profits and leading to a repricing of equities. Bonds, which had benefited from decades of declining interest rates, are also facing headwinds as yields rise. In contrast, gold and silver historically perform well during periods of high inflation and economic uncertainty, as they are viewed as reliable stores of value that retain purchasing power. From a technical analysis perspective, both gold and silver have shown signs of renewed strength. Gold has recently broken through key resistance levels, hovering around the $2,000 per ounce mark. This price level is significant because it has acted as a psychological barrier in the past. A decisive break above $2,100 per ounce would signal a major technical breakout, potentially triggering a wave of buying as traders and investors look to capitalize on the upward momentum. Silver, often more volatile than gold due to its dual role as an industrial and monetary metal, is also showing bullish signals. The $30 per ounce level is a critical resistance point for silver, and a sustained move above this level could lead to accelerated gains, similar to the price surge seen in 2010-2011. Market sentiment also plays a crucial role in shaping the price dynamics of precious metals. The current sentiment towards gold and silver is increasingly positive, as evidenced by rising inflows into gold and silver exchange-traded funds, ETFs, and increased demand for physical bullion. Central banks, particularly those in emerging markets, have also been adding to their gold reserves at a record pace. This trend reflects a growing desire among nations to diversify away from the US dollar amid concerns over dollar depreciation and the long-term fiscal health of the United States. The strength of the US dollar is another critical factor influencing gold and silver prices. Historically, there has been an inverse relationship between the value of the dollar and the price of gold. When the dollar strengthens, gold typically weakens, and vice versa. However, the recent trend of dollar strength may be approaching its limits as the US faces mounting fiscal challenges. The U.S. national debt has ballooned to over $33 trillion, raising questions about the sustainability of current fiscal policies. As investors become increasingly concerned about the long-term value of the dollar, many are turning to gold as a hedge against potential currency devaluation. Furthermore, the geopolitical landscape is adding to the uncertainty. Tensions between major global powers, including the United States, China, and Russia, have heightened in recent years. The ongoing conflict between Russia and Ukraine, as well as rising tensions in the Asia-Pacific region, have exacerbated fears of broader military escalations and economic disruptions. In such a volatile environment, investors often seek refuge in tangible assets like gold and silver, which are less susceptible to geopolitical risks than traditional financial assets. Given the compelling case for a new bull market in gold and silver, investors are faced with several options for gaining exposure to these precious metals. The most direct way is through the purchase of physical bullion, such as gold bars, coins, and silver rounds. Physical gold and silver offer the advantage of being tangible assets that are not subject to counterparty risk, making them ideal for those seeking a safe haven. Alternatively, investors can opt for gold and silver ETFs, which provide exposure to the metals without the need to store physical assets. ETFs are convenient and liquid, allowing investors to easily buy and sell shares. However, they do carry some risks, particularly if the underlying assets are not fully backed by physical holdings. For those looking to leverage the potential price movements, gold and silver mining stocks offer another route. Mining companies tend to outperform the metals themselves during bull markets, as their profits increase with rising commodity prices. However, investing in mining stocks also comes with higher risks, including operational and geopolitical risks specific to the mining industry. The current economic, technical, and geopolitical conditions create a compelling backdrop for a significant rally in gold and silver prices. As inflationary pressures persist, central banks struggle with policy credibility, and investors seek alternatives to traditional assets, the demand for precious metals is likely to increase. While no investment is without risk, gold and silver stand out as unique hedges in an era marked by uncertainty and potential financial turmoil. Investors who recognize these dynamics early and strategically allocate a portion of their portfolios to precious metals may find themselves well-positioned to benefit from the next bull market in gold and silver. In this evolving financial landscape, gold and silver are more than just commodities, they are symbols of stability and preservation of wealth. As the global economy faces mounting challenges, the appeal of these time-tested assets is only set to grow stronger. It is not just about short-term price movements. It is about safeguarding one's financial future in an increasingly unpredictable world.